In today's episode, I'm going to answer the most common questions I hear being asked about how to start trading. My name is Ross Cameron. I'm a full-time trader, and I see most of these questions being asked right here in the comments on YouTube. Now, at the end of today's episode, I'm going to provide you guys with some recommended reading for those of you guys that want to continue learning, and I'll also share with you some free resources for those of you guys who want to jumpstart your learning curve. Let's go ahead and start at the top of the list. Ross, what is the best way to make money in the market? Okay, straight to the chase. Here's the deal. When I think about the best way to make money in the market, I'm thinking about what's the lowest risk way to make money in the market. Because for me as a trader, I'm always thinking about risk. So from that perspective, the best way to make money in the market is to buy US Treasury bonds. They're guaranteed, essentially, fixed income. You buy the bond, you gain the interest, and when the bond matures, you get the money back, which is great. However, the interest rate is very small. So if you had, let's say, a $10,000 trading account, you've got a $10,000 trading account, your interest over the course of a full year might be 4%. 4% on a $10,000 account. That's $400. $400, that's it. That's not enough to make a living. $400 a year isn't going to cut it, right? So if you have a $10,000 trading account and you're going to be realistic, what's your daily goal? Maybe $200 a day, $1,000 a week. That's $50,000 a year. That means you need to find a way to grow that account 5x over the course of the year, a 500% return. You're not going to do that with US Treasury bills, all right? It's not going to happen. So now we've got this spectrum of risk and reward. And what you're going to learn very quickly is that you don't get reward without taking risk. So while the best way to make money may be to buy fixed income US Treasury bills, okay, that's fine. It's not going to give you the reward that you want. So now let's move to the other end of the extreme, which would be options trading. I think options trading is one of the highest risk strategies and ways to make money in the market. And the reason is because you have such a high probability of the option contract that you've purchased expiring worthless, just like a lottery ticket. And that's why I call those way out of the money option contracts lottery tickets. So there's a lot of traders during the GameStop short squeeze of 2021 that made a lot of money with some out of the money option contracts. But if we're going to be honest, they were lottery tickets. They were a once in a lifetime win. And it's not something you can repeat on a weekly basis, certainly. Not even on a monthly basis, probably not even on an annual basis. When was the last time we saw a move as big as GameStop? We haven't. GameStop was crazy. There have been a couple other big moves in the past, but GameStop was absolutely epic. So that's the highest risk and high reward. The problem there is it's high risk, high reward, and your accuracy, your percentage of success is very low. 1 in a million. Now, I know some of you guys are saying, so you're telling me there's a chance. Okay, maybe, but let's be real. Not really, not in a serious way. So we've got to bring the risk and reward down a little bit. All right, so where I kind of have settled in is day trading. And it's not day trading just anything. Some people say, Ross, why don't you day trade Forex? Why don't you day trade futures? Why don't you day trade large caps? And the reason is because, well, for one, I've tried day trading futures and I've tried day trading large caps and I've tried day trading options, and I haven't found consistency from those strategies. I have found that I consistently make the most money on securities, financial instruments that can go up more than 10% in one day. That rate of change, that's the volatility that I need to be able to make money. So for me, I don't feel like I'm taking as much risk in my strategy as if I were buying out of the money option contracts. I don't even feel like I'm taking as much risk as if I was trying to day trade Forex, futures, or cryptocurrency. I feel like trading small cap stocks for me is really the sweet spot where I'm taking a risk, but I'm getting rewarded, and where I'm maintaining accuracy, for me, between 68 and 70%. Just for the last 3 months, I've been averaging over 70% accuracy on my trades. So if you're like me and you have a relatively small account, in other words, not 10, 15, $20 million, where earning 4% on a treasury bill is a significant amount of money, but you've got $5,000, $10,000, $25,000, and you have a goal of making $1,000 a week or more, you're going to need to find an area of the market where you can get 400, 500% per year return without risking losing the whole account in one trade. And that's a tricky proposition. That's the struggle that I had when I was getting started. Ross, what is the best strategy to start with? So it's going to be biased based on my own experience trading. Someone else with a different strategy is going to maybe think their strategy is the best for beginner traders. Although I know a lot of successful traders out there who evolved their strategy to a point where it is no longer suitable for a beginner. Whereas maybe this is kind of sad, I have stunted development. I haven't really evolved my strategy. I basically have the same strategy. I've been trading for more than a decade. Haven't really thought about it like that before, but of course it works and I make money. The way I've been able to make more money is by taking more risk on every trade I take. What other traders do is to make more money, they change markets. So they switch to a different market where there's more liquidity and there's more scaling. And I've stayed in the small cap market. So for me, I'm kind of here in the trenches with you guys every single day, focusing on trading small cap stocks priced between 2 and 20 that are going up at least 10 to 15% in a single day, typically because why? They have breaking news. This has been my sweet spot. These 5 criteria for stock selection that I share with you guys in a lot of my episodes. And I'll put a link, I'll actually pin a link to the top of the comments and I'll link it in the description where you could download a selection of my PDFs. It's a suite of resources that's going to walk you through my stock selection process, the 5 criteria. It's also going to give you my trading plan. And I'm going to share with you one of my favorite candlestick chart pattern setups that I trade in my own trading just about every single day. It's the micro pullback strategy. And I'll also include my small account worksheet. Those resources, 4 PDFs, I think you'll really enjoy. So in my humble opinion, in my experience, biased as it may be, is as a beginner, if you've got a small account, $1,000, $3,000, $5,000, the goal, in my opinion, is to try to grow the account quickly, right? I mean, aiming for 1% a month is not going to be substantial. It's not going to be enough money to make it worthwhile. And it takes a lot of time to become good at trading. So my attitude is that, look, if you've got a $5,000 account and you've got a stock priced at $2.50, you could buy 1,000 shares of that stock at $2.50. You're putting half your account into it. If that stock goes up to $2.60, to $2.70, to $2.75, that's 25 cents. You're up $250. Boom, that's 5% in one day. That is a strategy that I can get my head around. That's something that I really like. Now, if I bought that stock at $2.50, what was my max loss on the position? $2.40. I'm risking $100 to make $250. That's a good risk to reward ratio, right? See, I'm thinking about risk. I risk $1 to make $2. I risk $100 to make $200. And I risk $1,000 to make $2,000. I risk $10,000 to make $20,000. And that's where I'm at right now, where I do take $5,000, $10,000, $15,000 of risk to make $15,000, $20,000, $30,000 in a single trade. And it does happen for me. So I'm still trading the same exact stocks that you may be trading with 50 shares or with 100 shares. It's just scaling up your share size. So for me, I think the best strategy for a beginner getting started is focusing on these low price stocks that have the potential to squeeze up 30 or 40% in a single day, because even if you only capture 5% of it, 5% of that, or let's say 10% of that, and you use half your account in it, that can be enough for you to grow your account with some consistency. So that's where I come from, is that you need to be focusing on trading stocks, number one, that have a catalyst, a reason to be moving higher. So if you're trading futures, you could trade a futures commodity that has a reason to be going higher. Gold, natural gas, a lot of these commodities they have economic reasons that they'll move up and down with different things that are going on with the world. So there can be catalysts there. But I would caution you that when you try to trade the futures market, or you try to trade Forex pairs, the US dollar to the euro, you're going to realize that you're competing against some of the most sophisticated, high-frequency trading algorithms in the world. So institutional traders, big hedge funds, they employ some of the smartest people, the smartest graduates from MIT, not to work on curing cancer or doing something maybe really meaningful, but just trying to create a computer program to print money from the market. And they look for securities that are very thickly traded, where they can just trade and trade and trade and trade, because they could do a lot of back testing on those types of securities, and they can continue trading them moving forward because they're so liquid. There's so many people buying and selling it. So I found my pocket of safety as a retail trader, right, being on this side of the fence, has been trading these smaller companies that come out with breaking news. So it could be a small biotech company that suddenly comes out with news that they've got FDA approval for a new drug they're working on. And just like that, boom, the stock could squeeze up 300% in a single day. And I have seen it happen. In fact, we see that happen on a regular basis. Trading biotech stocks is a core component to my strategy because biotechs just have this potential that when they come out with a big cure for some disease, it can turn the company around overnight. Now, of course, to learn more about the details of my strategy, my 5 criteria for stock selection, where I buy, my entry indicators and my exit indicators, the candlestick chart patterns I use, and a full trading plan that's going to outline the time of day to trade, where I get in, where I get out, everything else, you could download those PDF resources. They're pinned to the top comment. Now, the next question, Ross, what is the best time of day to trade? So I recently did an episode on this where I highlighted 5 unique times a day that are worthy of trading. And if you've had any interest in trading Forex pairs, you'll know that with Forex, there's very specific times a day that you could trade. And this is kind of interesting because Forex is a 24-hour market. And some people are thinking about the US stock market becoming a 24-hour market. And what's that going to mean for trading? Well, even though Forex is a 24-hour market, there's windows where you have heightened volatility on certain pairs. And those are when the economies and the markets essentially of those two countries where the currencies exist are both open. So they overlap in the windows of volatility. So when it comes to the US stock market, the market opens at 4 a.m. Eastern Standard Time. And right at 4 a.m., there's the first window of volatility. So your first hour of potential is at 4 a.m. Now, the movement that we see at 4 a.m. is typically the result of news that came out overnight when the markets were closed. And so the soonest traders can react to it is at 4 a.m. But naturally, most US traders aren't up that early. Certainly not West Coast traders, but even East Coast traders typically don't get up that early. So the people that are usually trading the 4 a.m. squeeze are traders in Europe or in Asia who are on a different time zone. So 4 a.m. tends to be lighter volume, although you can trade during that window. The only restriction is that a lot of US broker-dealers don't allow trading before 7 a.m., and it's just simply because they don't want to staff customer support as early as 4 a.m. So 7 a.m., from sort of all intents and purposes, is the next window. So 7 a.m. until 9:30 a.m. Eastern Standard Time. That is considered our traditional pre-market window, and that's when a lot of companies are actually putting out breaking news headlines. So when you get breaking news, that's the catalyst that suddenly creates that squeeze. So the company puts out news, the stock squeezes up 15, 20% in an instant. Traders see it on our stock scanners, and then we're buying the first pullbacks using the micro pullback strategy, as long as the stock meets all 5 criteria for stock selection, right? Price, relative volume, news, float, etc., the rate of change. So the best time to trade, 4 a.m. to 5 a.m., that first window of stocks reacting to overnight news, and then 7 a.m. to 9:30. And then there's a little window right at the open from 9:30 to about 10, which is the opening range. That's when a lot of traders do begin trading because 9:30 is the official opening bell. However, I'm not a huge fan of trading during that window because I find that it's not common that a company is putting out fresh news at 9:30. So you're essentially trading continuation from a stock that put out news maybe an hour earlier, in which case I've probably already traded it and the easiest trades are probably done. And then the next window of opportunity, so that's the first, the second, the third. The fourth window of opportunity is power hour, which is from 3 p.m. to 4 p.m., going into the closing bell. So as the day is finishing, there's a lot of position management where, depending on how a stock is looking on the day, shorts will begin to cover or longs will acquire a new position for an overnight hold. So 3 to 4 p.m. is power hour. And then the fifth window is after hours beginning at 4 p.m. and lasting until between 5 and 6 p.m. And that's because companies also put out fresh news after hours. So in total, while you have 5 windows of opportunity, the 4 a.m. window, the 7 a.m. to 9:30 window, the 9:30 to 10 a.m. window, the 3 p.m. to 4 p.m. window, and the 4 p.m. to 5 p.m. window. In reality, I do the best between 7 a.m. and 9:30 a.m. That is the 2.5-hour window where I'm consistently making the most money. Now, part of that's because of my schedule. I'm on the East Coast. If I was in Europe or in Asia, would I get up or would I trade at 4 a.m.? I probably would, and I would trade until 9:30 or 10 a.m. That's probably what my schedule would be. If I was in Australia or Japan, I would adapt my schedule knowing that these are the 5 windows where I can expect volatility. So essentially, I have to choose which of them do I want to focus on trading. But I'll caution you not to flip flop. It's important to approach the market with consistency. So I'm all about treating trading like a business. And just like any other business, you want to have a business plan. The business plan is going to stipulate the type of stocks you trade, where you get in, where you get out, your entry indicators, your exit indicators, the time of day you trade, and you want to approach the market consistently. So if you're going to trade from 2 p.m. to 5 p.m. every day, that's fine, but just make it that's the time you always show up. That way, as you're trading and as you're collecting historical data from your own trades, you can base them on, okay, this is my accuracy during this time of day. Because if you just trade a little at 7 a.m. and then a little bit at 4 p.m., you don't know if the issues you're having, maybe one strategy works well early and it doesn't work later. Different order types, things like that. There's too many variables. So it's better to approach the market with consistency and choose the time that you want to trade and then show up at that time every day as much as possible. How much money should I start trading with? All right, so this is a question I see posted almost every single day, and I'd say there's 2 answers. The first is don't worry about it because right now it doesn't matter. And the reason I say that is because right now your job is to practice in a simulator, which means you're not trading with real money. Prove that you can make money in a simulator. Because if you can't make money in a simulator, you shouldn't even fund an account with real money. There's no point. So that's the first answer. Focus on trading in a simulator, build consistency, build success. And then let's just say for a second that you've been trading in a simulator for 5 months. You're accurate, you've got great accuracy, you've got a great profit loss ratio, you've made 25 grand in the simulator. You're making money $200 a day, $1,000 a week, boom, boom, every week, month after month. Now it's been 4 or 5 months. So at this point, you know what you're doing. So you know that you're going to want to start a real money account as soon as possible. So while it would be great if you could set up a real money account with $5,000 or $10,000, if the most you could get together is $1,500, you're going to do it, right? Because you know you have the metrics. You now have confidence in yourself. And that's so important. Confidence in yourself is one of the biggest contributors to your long-term success. You have to believe in yourself, but it can't be based on just, a false sense of confidence. It has to be based on actual historical records, actual track record. So you build that in the simulator first. So when you fund an account with real money, you have a couple options. You can, of course, fund an account that's a cash-only account. You set up a cash-only account with a couple $1,000, $2,000, $3,000. You could trade that cash balance once a day. And when you run out of money, you got to wait till tomorrow. In the United States, we have what's called the pattern day trader rule, the PDT rule, which means you've got to maintain a minimum balance of $25,000 in your account in order to day trade. And even if you're Canadian or you're an international resident, if you open an account with a US broker-dealer, they're going to force you to follow the $25,000 rule. However, what's interesting is that $25,000 minimum rule is only enforced in the United States by US broker-dealers. So if you're Canadian, don't open an account in the United States. Open an account with one of the Canadian broker-dealers. So Canadian broker-dealers or international broker-dealers that accept Canadian customers. So those would include Centerpoint, Interactive Brokers, Trade Zero, or Ocean One Securities, just to name a few. Webull is to name a 5. So those are brokers that would accept Canadians that do not enforce the pattern day trader rule. If you're from Europe or you're from Australia or a country in Asia, it doesn't matter. Why would you open an account with a US broker-dealer and subject yourself to the rule? International brokers are going to be probably your preference. So Webull, again, it operates in a number of different countries. That's one option. Trade Zero is another option. They offer commission-free trading on non-marketable limit orders. And then Ocean One Securities is yet another option. Ocean One Securities and Trade Zero, their account minimums, I think, are $1,000. So you could start day trading with $1,000. And those two brokers also both offer 6 times leverage, which means when you put in $1,000, you have $6,000 in buying power. Now, I'm going to tell you right now, I have no affiliate relationship with any broker-dealer. So you sign up for whatever account you want. It doesn't make any difference to me. I'm just sharing with you the resources that I wish I had known about when I was getting started. So when I was getting started, there weren't offshore brokers that even accepted US traders at that time. So I had no choice but to fund an account with a full $25,000. And I used money that I had inherited when my father passed away in 2007. So when he died, I got this money and I used that to create my first account. And to be honest, that was a mistake because I had a huge amount of emotion attached to this account. It's like it felt at times like it was all that I had left of him and I had to make him proud. And that was really painful for me. It made learning to trade harder because I created this pressure that was unnecessary. So, and I've heard of people doing crazy things like taking out a car loan or, taking a cash advance or something to fund a $25,000 account. And then you press a couple keys wrong and you lose it. So that's scary. I encourage people to start with small accounts because when you start with a small account, you'll make mistakes, but the costs are low. In fact, there was a trader in the chat room at Warrior Trading today who said, I just took a huge loss and I'm so upset. And they were a new user. I could see they were new within the last 14 days. And I was like, okay, slow down. I hope it wasn't too bad. And she was like, well, no, I'm just trading with with one share. So she lost a full dollar a share. She lost $1.23. And I was like, okay, yeah, well, I'm glad that it was only a single share position because other traders will come into the market with that $25,000 account. They'll start punching orders for 5 and 10,000 shares, and boom, they're down $7,500 in an instant. So you're going to make rookie mistakes. I did. Everyone does. Use a small account so the costs and the mistakes are low. The lessons are the same. You learn the same lesson whether you lose $1 a share with one share or you lose it with 10,000 shares. So learn the lessons with a small account. I'm a big advocate of this. But first, practice in a simulator. Ross, what is the best broker to use for day trading? So I already kind of got into this a little bit in the answer to question 4. Different brokers for different regions, depending on where you're located. I have done episodes that break away on all of these topics. So best broker for Canadian residents, I have an episode for that. Best brokers for traders in the UK, I've got an episode for that. Best brokers for international traders, best brokers for US traders, best commission-free brokers. I've done episodes for all of those. So what I'll tell you high level, in the United States right now, I would say the best broker for a cash account would be either Charles Schwab or Webull. Those are the two top. Webull has a better platform. Charles Schwab is a little bit of a more popular platform, but both enforce the $25,000 PDT rule. If you want to look at offshore brokers, you're going to pay more money for them. They charge fees and commissions. They charge platform fees, so it gets more expensive. You shouldn't do that unless you've already practiced in the simulator, so I urge caution, but that's a consideration you can make. Trade Zero, Capital Markets Elite Group, and Ocean One Securities are the 3 that are popular right now. But these brokers also kind of come and go. The US brokers, for the most part, stay the same, but some of the international ones do come and go. So in my experience, and based on my testing, the fastest broker for fastest order execution are as follows. Number 1, Lightspeed Trading. Number 2, 3, 4, pretty much tied. Centerpoint, Cobra, and Guardian Trading. And then CMEG, Capital Markets Elite Group, Ocean One Securities, and those are the top 5 or 6. And then the fastest U.S. broker-dealer that is a commission-free broker was TradeStation. So that's kind of the top list, real quick rundown of what I would consider to be the best brokers. But I break away episodes where you can read and learn more about my really pretty comprehensive breakdown and comparison of the pros and cons of each one of those brokers. I can't trade between 7 a.m. and 9:30 a.m. So should I just give up on this endeavor to be a trader? So as I said before, although that's the window that I focus on trading, part of that is because of the time zone that I'm located in and my schedule. There are the 5 windows of the day, and you could choose one of those other times to trade. So if you're in Europe and you want to trade earlier in the day, you could certainly do that. If you want to trade later in the day, you could certainly do that. And you could still use the same strategy that I'm trading, which is focusing on stocks with news that are squeezing higher. Your best bets for breaking news will be 4 a.m. and then between 4 a.m. and 9:30. So that whole window. And then between 4 p.m. and 8 p.m. after hours. Between 9:30 a.m. and 4 p.m., we don't usually have breaking news. Occasionally we do, but not typically. So that window can be a little bit slower, although you can have stocks that are getting continuation because they had news that came out earlier, or people are anticipating news that's going to come out a little bit later, say at 4 p.m. at the closing bell. Can trading be a side hustle? So, over the years, I've known a lot of people who work a regular 9-to-5 job, but trade outside of that. So they trade in the morning before they go to work, or they trade when they get home from work. So traders in Europe, I hear about this all the time. So the market opens, well, 9:30 a.m. Eastern Standard Time, 3:30 p.m. in Europe. Well, depending on what part of Europe you're in, but 6 hours ahead. So I know a lot of traders who say they kind of call it a day at 3 p.m. so they can start trading the US market open. I know other traders out in California who will get up early and trade the 9:30 open, which is 6:30 in the morning in California, and trade that first hour and then go to their day job. So you've got traders on all time zones and even right on New York's Eastern Standard Time zone who make trading a side hustle and trade around a regular work schedule. In fact, I think that probably, if I'm going to be honest, one of the most attractive things about trading is that you can fit it around other things you're doing. So, and it's especially true if your work is flexible. If you're a freelancer or you have the type of work where you're doing like a week on, week off, or you're doing seasonal work where you have a full 3 months off or something like that, that can lend really well to trading. Now, I also know people that will do a number of side hustles. So they might do, driving for Uber or DoorDash or something like that to make kind of side money while studying and learning about trading. And they're learning by listening to podcasts, listening to books on tape, watching YouTube videos like this, but just listening to them while they're doing other things. So, but they're also making money while they're doing some of those other things. So I'm a big advocate of just essentially, when it comes to the financial markets, gaining financial literacy. The more time you spend learning about the markets, just immersing yourself in this community and this culture of people that are speaking the same language, the more you're going to benefit. And whether that means you become a full-time trader or it just means that you're more equipped to make good decisions when it comes to your 401k or using a Roth IRA for retirement investing, it's only going to better you to learn more about the financial markets. When should I start using a simulator? So sometimes I'll hear people ask this, and in part it's because using a real-time simulator with level 2 market data is going to incur some market data costs. You don't get market data for free. That's the one disadvantage. Now, some brokers like Webull, Thinkorswim, with Charles Schwab will offer simulated trading, but typically they have sort of restrictions around it where maybe it's free, but it either only works during certain hours of the day or you don't get all of the data. So if you want a real simulated trading experience, you're going to have to pay essentially for real trading software, the same software you would use with real money, which is great training because you get to experience this exact same software, but just connected to a simulated exchange. So those can range from $50 to $100, and I've seen some as high as $175 a month. So they can be expensive. And so here's what I would say. It's best to start sooner. The best time to have started simulated trading was, 6 months ago. The next best time is now, if you can dedicate the time. So if you can't spend at least 1 hour a day when the market is open, then no, it doesn't make sense to fund an account and or to spend the money on the simulated trading account, the subscription fee. So you need at least an hour a day that you can trade, and you can approach it relatively consistently. Trading from your phone, yes, you could do that just to kind of mess around, but that's not going to be a really good experience for what it's like to day trade. Professional day traders don't trade on their phone. We trade on a computer. We use desktop trading software. And Mac both are fine. It doesn't matter really in that regard, but you need to be able to spend at least an hour a day actually on the computer practicing trading. So as soon as you're able to do that, at that point, I would get yourself set up with a simulator. We do offer a simulator for members at Warrior Trading, which you're welcome to check out. Our simulator is $100 a month. It's not the cheapest. It's also not the most expensive. So you could check that out if you're interested. But there's other simulators that you could use as well. When it comes to replaying market data, this is something that unfortunately is fairly rare. Replaying the market data at night, Thinkorswim does offer a replay, but it doesn't include level 2 market data. It just includes a replay of the chart, which is helpful. But as you may know from my strategy, level 2 data is very important. And the nuance of what I see on the level 2 is often what gives me that final buy indicator or the sell indicator. So while practicing trading at night on the replay with just charts is okay, you can't get the replay with the level 2 data. And the reason is because saving the level 2 data for every second of the day, for every stock you might want to trade, is an insane amount of data. And it's just not cost effective for anyone to do it. So at this point, no one is offering a replay with full level 2 market data. But when it comes to simulated trading, the best time to get started is once you're able to dedicate, I'd say at least an hour a day, if possible, several times a week to trading the markets. When should I go live from being in the simulator? I hear this all the time. Ross, I've been in the sim for a month or for 2 months. Should I go live or should I keep sim trading? Well, trading in a simulator is an important phase in your journey of learning how to trade, but it's not a place that you should stay for a long time. I've heard of people who have traded in a simulator for years, and I don't think that that's productive. To me, trading in the simulator, it's like bowling with bumpers. It's important. Well, it's more like riding a bike with training wheels. It's important because you don't want to lose your front teeth. But at a certain point, you got to graduate. You're never going to win the Tour de France with training wheels. And you got to kind of get out there and start catching your balance. And maybe that's not the perfect analogy, but the problem with trading in a simulator is that you can get an artificial sense of confidence that you're really, really good when you're not yet experiencing the emotions that come with trading, the actual fear of this could go wrong. And so I encourage trading in a simulator for a period of several weeks, if not several months, to learn the basics of how to trade, to learn how to read level 2, and to make those rookie mistakes with pressing the wrong buttons and buying when you meant to sell or selling when you meant to buy. Get all those mistakes out of the way in a simulator. But then once you're showing that you do know how to make money, you know how to get in and get out and make a little bit of money here and there, that's when it's time to flip the switch and go live. But do it in a small account. Do it in a small account and start trading just with one share. Just one share, and then go to 10 shares, and then go to 20, and then to 50, then to 100, then to 200, to 500. And over the course of 6 weeks, 8 weeks, several months, 3, 4 months, make your way up to 1,000, 2,000, 3,000 shares. Slowly increase. And what you're doing by approaching it in this way is you're conditioning yourself to experience loss, because you will experience losses as you're learning. And when it's with one share or 10 shares, it's negligible. When it's with 10,000, your heart's pounding and it's big. So you got to work your way up to that level. So at my point now, where on a big trade, I might take 50,000 shares. Yeah, if I lose 10 cents a share, I'm down 5 grand. Wow, these are big numbers. It took a long time to get to the place where I could be down 3 or 4 grand and not bat an eye. And you're not going to be there overnight. So you've got to condition yourself, and that's that behavioral conditioning. You just expose yourself to the losses and let them get a little bigger, a little bigger, a little bigger. And during that time, you're continuing to track all of your metrics. Your accuracy doesn't matter if you're trading 10 shares or 10,000. Accuracy is accuracy. Your profit loss ratio is your average winner and your average loser. Obviously, the numbers are going to get bigger as you scale up, but the ratios, the comparison between the two on average, as long as you're scaling over the course of, week to week to week, you can measure each week on its own. So I'm really a big advocate of going live earlier rather than later, but doing it in a safe environment, which is with a small account. And it could be a cash-only account. You could fund an account with a couple $100s and just trade one share. When you're trading cheap stocks, you're not going to run out of buying power. So then you add more money once you start hitting that ceiling where, I need more money to keep trading the way I want to trade. And that's where, once you've got that track record, it's not like, I don't think I'm going to be able to come up with the money. It's, how am I going to be able to come up with the money? I have something I know is going to make me money. I just need to fund the account. So if that means I've got to do Uber for a couple months or whatever, I'm going to do it to raise the money to fund my account. And I'm going to take it really seriously when the account is funded, because I'm going to know the stakes. It took me time to get to this level, and I've got to have the discipline to respect the risk. Ross, I heard you say you stopped out pre-market, but I don't understand how you're getting your stops to work pre-market. Okay, so let's talk about stop losses for a second. So when it comes to trading, risk management is critical. We've got to manage our risk, right? No question about it. So there is a mechanism in the market called a stop order. And the way a stop order works is if the stock drops below a certain price, an order can execute. So let's say you bought a stock at $5. You could set your stop loss at $4.90. And if the stock breaks $4.90, your broker will send an order to sell your position straight to the market. Now, it'll sell most likely while the stock is dropping. So it sends the order when the stock's at $4.90, but you might not get filled till $4.88, $4.85, maybe even lower if the stock is dropping quickly. However, stop orders only work beginning at 9:30 a.m. and then ending at 4 p.m., only work during regular trading hours. They don't allow stop orders pre-market or after hours. Even during the time when I was really only trading during regular hours, I still didn't use live stop orders. And the reason I didn't use them is because I found it too cumbersome to put the stop order out and then cancel the stop order when I wanted to sell half of my order. Because imagine this, you have a stop order out to sell at 490. You then sell half at 525. You sell another quarter at 525, and you don't ever cancel that stop order. Later, the stock comes back down, it executes that stop order, and it sells the full position. You're now short the stock. And that was a mistake that I made a few times. So I realized, you know what? I don't want to leave orders out like that. So I don't do it. But that requires a high level of discipline. It means you've got to be able to stop out manually, mentally. You've got to actually exit. So sometimes I'll say, guys, my mental stop is 490. And that means that's the price where I'm going to sell if this thing drops. But a mental stop is only as good as the person enforcing it. So if you're not good at enforcing it, then you may be better off using live stop orders. But I personally don't use them in my trading, but I trust myself to go ahead and press the sell button. I have the sell button actually scripted to a hotkey on my keyboard, and so my hand is typically hovering over it while I'm in a trade. Now, for my strategy, I'm only taking generally one trade at a time. I'm focused just exclusively on that one setup, and then once I don't like the position, I'm out and I'm all cash. So it's not asking a lot for me to just stay focused on that stock and manually be ready to sell if I see an exit indicator. Ross, what are some of the exit indicators you use to tell you when to get out of a trade? Okay, so let's think about it a little differently first. What are some of the things that you want to see right after you buy? You buy a stock at $6. What do you want to see? A surge of buying. You want to see it immediately go to 615, 620, 630, 640, 650. You want to have a cushion on the trade instantly. So you want to see green, you want to see buying, you want to see a cushion. What don't you want to see? You don't want to see a big seller suddenly at 625. If all of a sudden you saw a 300,000 share seller at 625, it's going to tell you to get out of the trade, right? There's a big seller block in the way. So that's no good. What if you get in and it just stalls out? So the way I think about exit indicators is I think about essentially the inverse of everything that's good. So if I suddenly see a big seller, if I suddenly see a bunch of sell orders on the time and sales, those for me are exit indicators. And it doesn't matter if I'm only up 2 cents a share or I'm up 30 cents a share or I'm up $2 a share. Once I see those exit indicators, I'll jump out of the trade. Now, if I'm up a ton on the position, I might just sell half of my trade, my open position, and hold the rest, and then consider maybe holding while a new setup forms. But generally, I get in, I get out. I get in, I get out, and I don't just hold a position when there's not currently a valid setup for my strategy. I don't usually have such a huge profit that I can just kind of hold and let it do that when the pattern doesn't make sense. I'm usually all in and then all out. So for me, my exit indicators, big seller, bursts of selling on the level 2, or the stock just stops moving higher. It starts to pause. Because once it starts to pause, it's hesitating. And that means there's some indecision. Now, the candlesticks that represent that indecision could be a doji candle, a topping tail candle, a shooting star candle. But the fact is, by the time that candle has formed, you should have already been able to see the price action that created that candle on the level 2. So there's this relationship between level 2 and the candlestick charts where I would challenge you to try to read the level 2 and imagine in your eye what the chart is doing. So you could even draw it. Hide the chart, just watch the level 2 and draw out what you think the candlesticks look like. Oh, this one has a topping tail. This one's got a little pullback. This one's got a bottoming tail. Because the chart is really just the historical record of the orders that went through the time and sales that were at one point buying and selling right on the level 2. So the better you can get at connecting the two, I think the better you'll do at spotting those exit indicators a little bit sooner. Ross, tell me about your turning point. Did you have an aha moment? So my turning point when it comes to trading, it was rock bottom. I had to hit rock bottom before I turned things around. And I hate to say that I think that needs to happen for a lot of people, but I think it is true. And the reason I hate to say it is because I've seen so many traders who lost far more than they needed to lose before turning it around. And in fact, I think this is one of the advantages with coming to the table without a lot of money because rock bottom is a lot closer, which was the case for me when I was getting started. So I hit rock bottom, but it wasn't like I lost millions of dollars learning to trade. I hit rock bottom pretty quick. So here's my story. So when I was learning how to trade, I went through this a little bit of beginner's luck. My first year, I made about $25,000, $30,000, which at the time was half of my goal of $1,000 a week. Not bad, but also look, it wasn't bad. It was pretty good considering my first year in. Most people lose money, so it wasn't where I wanted to be, but it wasn't bad either. Now, in the second year, I lost 30 grand, and this was a real problem because the money I had made in my first year, I had been using to cover my cost of living, and I'd been dipping into a little bit of my savings to cover cost of living to sort of make up the difference because I wasn't making enough trading. So in the second year, when I was making nothing trading and I was just losing money, well, this was a problem. My cost of living was now going on the credit card. So all of a sudden, I'm now accumulating credit card debt. And I'm thinking to myself, I'll pay it off as soon as I'm going to pay it off. I just need a couple good months. And I kept feeling like I was this close to turning the corner. I had already had some consistency and then I'd kind of gone into this rut. So I just felt like I was so close. And what kept happening was every 4 to 6 weeks, like clockwork, I would have a day where I would go red. And rather than just throw in the towel and walk away, I would keep trading and keep trading and keep trading until next thing you know, I dug myself a huge hole and given back all my profit on the last 4 or 5 weeks. So it was literally like I would go from, basically zero profit. I would make $3, $4, $5,000, and then one day I'd lose 5 grand, back to square one. And that kept happening. That was my problem. And I realized this was not a problem. I'm going to be honest. The problem was up here. The problem was emotion. That was my biggest problem. It was emotion. I was getting frustrated. And so my turning point was another one of those big red days. But this red day was big enough that I wouldn't be able to trade without funding my account with more money. So my account was offline. So during the time my account was offline and I couldn't trade, for lack of anything else to do, I printed out all of my trades. I started sorting them in an Excel doc and really getting super analytical about figuring out what was working in my trading and what wasn't working. And there were a couple of discoveries that I made. I did realize that no doubt emotion was a big problem, but I also recognized that my biggest losses were happening in the afternoon because I was getting desperate. My biggest losses were on higher price stocks. They were on sometimes options trades or on large caps where I was swinging for a home run, taking a way too much size and getting completely smoked. And the stocks I was most consistent on were stocks that met my 5 criteria, my 5 pillars for stock selection that I continue to use today, which you guys can download with that link that's pinned in the top of the comments. So that was my discovery. My kind of big epiphany was that, Ross, you'd actually have been very profitable over these last 6 months, over the last year that you're currently in a drawdown, if only you made these slight adjustments. And that's why when I say I felt like I was this close, I was this close. I just need to stop doing a couple of things. I just need to make a couple of small, subtle changes. So what did I do? I sold some stuff in my barn on Craigslist and on eBay, raised some money, got my account back up above so I could trade it, up above the PDT minimum, which at that time was, I didn't know any other way. So I was back above that level. And with that, I came back to the table with a renewed sense of discipline and focus. I knew what I needed to trade. I knew the type of stocks I need to focus on. I knew when I needed to walk away each day. And I was willing not to trade if I didn't see anything that was perfect. I realized that, in fact, even if I only took 1 or 2 trades a week, I would make more money than taking 30 trades a day. Now, at that time, I was paying fees and commissions on every trade I was taking, right? This was back at a time when with E-Trade and Ameritrade, you would pay $10 on every trade you took. Now you could negotiate maybe down to $7 a trade, $6 a trade, but still you take 10 trades, you got $60 in commissions, right? Well, 10 trades, don't forget buy and sell, $120 in commissions easily every day. My daily goal was 200 a day. Most of that was going to the broker and I was ending up with nothing. So I realized less is more. And because of that, I said to myself, when you see a setup that works, you can take bigger size, but don't take anything that's not that setup. And so if I didn't feel confident enough to take the big size, I wouldn't take the trade at all. And so the result was fewer trades, increased accuracy, focusing on higher quality stocks. What was the result? Profit loss ratio got better. My winners were better. I was cutting out a lot of the unnecessary losses, and I began a track record of consistency. I grew my account, and although I had setbacks after that, that was my big turning point. So you guys are kind of in a unique position because you can essentially, I feel like you can start from my turning point. You can start from the point where here is my strategy. I'm sharing my strategy with you. You guys who are members of Warrior Trading, those guys who download my resources, you essentially get with my resources, the outline of my strategy. You go through my full curriculum, you fill in all the details. Everything about my strategy, you can watch, you can learn. I will teach you. Okay. But here's the deal. If you want to find success, there's something you need to bring to the table, and you need to bring the discipline. I've learned over my years that there are two leading causes of failure. The first is a lack of strategy. That doesn't have to be you after today. The second is an inability to have the discipline to follow the rules. And that's something that even I struggle with at times. Having discipline can be very difficult, but I'm telling you, the better you get at being disciplined in trading, not only will you make more money, you'll be a better person. And coming from where I'm at now, which is, more than a decade, far more than a decade later, now I'm a father, I'm raising young kids, and the discipline, the patience that it takes, I'm like, wow, I'm really glad I learned this in trading, because trading brings out all the emotions. They bring them to the surface, stuff that you need to work on. And you can choose to work on it and become a better person, or, you don't, and you don't get there. So to me, that's something I didn't expect about trading, was that it would force me to look in the mirror and really look at these aspects of myself that I needed to honestly improve. And, discipline and patience, those are big for me. I like to say that trading didn't come naturally to me. Yeah, I had a little bit of beginner's luck, but I mean, look, I've seen people during the pandemic who made $1 million in, a matter of months within sitting down. I mean, that's beginner's luck. That's like life-changing money, and they made it right away. Trading for me was a struggle. I had to untrain myself of a lot of bad habits up here with revenge trading, emotionally fueled behavior, just FOMO, greed, disappointment, frustration, all of that. And a lot of that came from very legitimate purpose or legitimate places, starting to trade with money that I'd gotten from my father and, so on and so forth. But it doesn't matter where it came from. It's here, and it's not helping me be a better person. It's not helping me be a better trader. So you're in a position now where you're going to have the roadmap, you're going to have the plan, but you've got to bring the discipline to follow the rules. And you have to bring some aptitude. There's no question about it. I'm fortunate that I grew up at a time where I learned how to use the computer from a young age. That may be the same with you. So computer skills, that was no problem. Typing, no problem. Playing video games when I was younger, good hand-eye coordination, so can trade, use the hotkeys very quickly. Those are some personal aptitudes that I brought to the table, which have certainly helped me. And if you have them, will likely help you as well. If you don't have them, then, that's another little sort of item on the list that you'll need to work to improve. But they can all be improved like anything else if you want it. And this is the thing with trading. Something as amazing as trading and the life that comes with trading doesn't come without hard work. Now, as promised, at the end of this episode, I want to share with you some recommended reading. So I already gave you a link to the free resources that you guys can download. That link is pinned to the top comments and linked in the description. And when it comes to recommended reading, I would encourage you to read the book called Quit by Annie Duke, to read the book called Thinking in Bets by Annie Duke, and to check out the book The Happiness Advantage by Sean Achor. Those are some really great books, and you're going to learn that success trading is all about mindset. Thank you guys, as always, for tuning in. If you enjoyed this episode, I hope you hit the thumbs up, and I hope you subscribe to the channel, and I'll see you for the next upload real soon.